to the big day in the markets with not one, but two central bank announcements, both the Bank of Japan and the U.S. Federal Reserve. Here with me today is Michael Dolega from TD Economics to explain what changed and why it matters to Canadian investors. So let's start off with Japan. What happened today?
Well, the Bank of Japan has been wanting to get inflation back up to target for some time. It seems like they've never been doing enough to do it. At this point, they're really trying to pull out all the stops and try some different things and make sure that they're going to get back onto target as far as the inflation outlook is concerned.
And what exactly did they change in terms of their policy, and do you think it's going to work?
Well, the two things that the two main takeaways really are the fact that they look like they're going to allow inflation to run hot. Hopefully that's going to be take place. Secondly, they're actually instead of just targeting the overnight market for interest rates, are also looking at controlling the long-term bonds, so the 10-year JGBs. From that standpoint, it's sort of a novel approach. Is it going to work? That's a very difficult question to ask. I think there's a better chance that it works at this point than it was yesterday. I think that the additional stimulus measures should help lift inflation and expectations for inflation going forward.
It was clear that the Bank of Japan was very focused on stimulus. In terms of the U.S. Federal Reserve, it was widely expected that they could potentially remove some of that accommodation. What happened today?
Well, the Fed is in a very different position as far as the cycle in the economy. Most members of the FMC, many members of the FMC believe that we're close to full employment. Inflation is running still a little bit weak, but we've seen signs of it heating up in the recent data. From that standpoint, many members believe that it's time to raise rates. The Fed at this point decided to stand pat. However, they just said they're going to do that for the time being. And I think if the data continues to improve, show resiliency, they're basically going to pull the trigger in December and raise rates by another quarter point.
So if we bring all of these decisions back home to Canadian investors, we know the Canadian economic growth is pretty sluggish. We saw that the growth forecast was cut for 2016. What do you think is next for Canadians? What's the takeaway here?
Well, very low for very long, I think, as far as rates are concerned. But and that's going to be. I think the economy is you're right, is sluggish. That rotation of resources from the energy sector to exports, it's taken longer to materialize, and the Bank of Canada is well aware of that. Obviously, the U.S. growth hasn't been as strong as we would have expected. Global growth hasn't been as strong as we would have expected. Those things have weighed on it. Plus, there was some transitory factors. At this point, we do feel that evolution is going to continue, but it's going to be quite protracted. And from that standpoint, we don't expect the bank to do anything as far as rates until probably early 2019.
Thank you very much, Michael.
Thanks for having me.
I'm Sarah D'Elia, and that's your Breaking Insight.